What's up, traders? So today I'm going to show you 3 stocks that I'm actively trading this month, or I at least plan to, in order to generate a good amount of income. But if you're new to the channel, my name is Rashad. I am a full-time trader. I bring in multiple 6 figures a year trading options. And options pretty much pays for not only my life, but my entire family's lives and our several vacations per year. So without further ado, let's get down to business. Now, before I unveil the first stock, I do want to say that I am an option seller and very rarely use option buying techniques. The reason for that is I love to generate consistent and reliable income on a regular basis. Most of the students that I teach are trying to either supplement their 9-to-5 income or they're looking to totally replace their 9-to-5. And for that to work, you need to know exactly how much money you're going to make on a regular basis, and you need for it to be reliable. So I focus on strategies that have over a 90% win rate. Now, with that being said, the very first stock that I'll be trading is a stock that I have made over $100,000 every year for the last 3 years on. And that stock is no other than Tesla, ticker symbol TSLA. Now, I'm assuming you've all heard of Tesla, but if not, it is the leader in EVs, electric vehicles. But the reason I love trading it so much using options is because it does have a good amount of volatility to it, which means that the premiums are always higher than most companies. But one of my favorite option strategies to use on Tesla is the iron condor. So a few of the benefits of an iron condor is a low cash requirement, you get limited risk, and you get consistent income generation from the premiums received. And of course, the objective is to generate income and profit from the stock price staying within a specific price range. So let me show you an example of how that would work. So let's say we have an imaginary stock that is currently at $70. What we could do to open up a iron condor is we can sell a put at $65 and then buy a put at $60. And then simultaneously, we will also sell a call at $75 and then buy a call at $80. And for that, we will receive $300 and our max loss is $500. So you can just kind of see with this picture here, price is currently at $70. And as long as it stays within this $10 range of $65 to $75, you make your money and you go about your day. But let's place a real trade on Tesla right now to see how it looks. So here we have Tesla's options chain pulled up. And the first thing we need to do is select an expiration date. So this is kind of up to you. So you can kind of determine if you want to make some weekly income, bi-weekly, monthly, quarterly. But let's say you want to make some bi-weekly income. So we'll go about 15 days out. So we selected the 15-day out expiration date. And now we need to select strikes. Now, one thing I like to look at when I'm placing an iron condor trade is what is that stock's expected move within the time frame. So now that we know we want to select this date 15 days out from now, let's take a look and I'll come over here to the expected move 15 days out from now. It looks like they're expecting Tesla to move about 10.78% from now until then. So that gives us a high price of $267 and a low price of $215. So we'll keep that in mind. We'll come back over to Thinkorswim, and I want to make sure that I select strikes that are outside of those ranges. Now, the next thing I look at is the delta. Now, the delta is just the probability that the event occurs. So if we come over here to this column, you can see it says delta here, and we will scroll down. With delta, I like to select a delta that has 0.05 or less. So that just means that Tesla has a 5% chance of hitting that strike by that expiration date, or AKA you have a 95% probability of making your money. So I'll come down here and we'll scroll. So 187.5 here is the highest put strike that I would select. So I'm going to right click, hit sell, and go to iron condor. And now that we've selected our short put strike, we now need to select our long put strike. And for your long put, it's totally up to you. It's just dependent on how much risk you're willing to take. If I select a long put strike that is $10 away from my short put strike, so let's say I selected 177.5, so that is a $10 difference, which means I would have $1,000 at risk per contract because every options contract is times 100. So that's a $10 difference in price, which will mean $1,000 at risk. For me personally, I like to go a little further out. So I'm probably going to select my long put strike at 167.5. So that is a $20 difference. So I'll come down here, select 167.5. Now we need to select our call strikes. So I'll scroll down here. Again, I'm looking at the delta column, so I'll keep scrolling. And it looks like 0.05 is the $330 strike. So I'll select the 330 for my short strike. And you want to keep your widths consistent on both sides. So since I did a $20 width for the put side, I also want to do a $20 width for the call side. So we'll come over here and I'll select 350. And all right, we can see the premium I will receive is anywhere between $1.01 to $1.05. So of course, when you times by 100, that is $101 to $105 per contract. So if we wanted to do 10 contracts of this, if we felt pretty comfortable, go ahead and select. Now the premium is up to 106. Hit confirm. And you can see after fees, I will collect $1,043.44 right here, right now, as soon as I place the trade. And as long as Tesla's stock price stays within my ranges, I will make money. But I know you're like, Rashad, I have a small account. I can't really trade Tesla in the way that you're trading Tesla. I got you. If you have a smaller account and are still interested in trading Tesla, then you could use a leverage ETF. Now, a leverage ETF is just an ETF that looks to follow either a stock or a sector, but it looks to move 2 or 3 times the amount on a daily basis that stock or sector moves. So a stock following Tesla, if Tesla were to move up 1% for the day, then the leverage ETF will move up 2 or 3% for the day. And the same thing works in reverse. If Tesla were to move down 1%, then it would look to move down 2 or 3% for that day. Now, as option sellers, we love that volatility because we receive more premium for trading those stocks. And many leverage ETFs trade at a smaller price than the stock or the sector that they follow. And that is the case for TSLL, which follows Tesla. So we can see here that TSLL is currently trading at $11.66. So it is perfect for people with small accounts. So we can come over to Thinkorswim and let's place TSLL into the options chain. And we'll select the same exact expiration date 15 days out from now. But if you come over here, you can see that the premiums are very, very nice, especially compared to how small the stock price is. I mean, the $10 strike has a bid and ask of 61 to 64. So if you have a small account and want to trade Tesla, you can use TSLL. So that is the first stock I will be trading this month. And the second stock will be, but wait. What if you can make money while on vacation, while spending time with your family without constantly worrying about bills? What if you can make the money for your entire vacation while on vacation? I personally trade options full-time and generate multiple 6 figures per year, enough to comfortably provide for my wife and 6 kids, and our multiple vacations per year. In Trade to Freedom, I'll show you how to create passive income streams that keep paying even when you're not working. You'll get my exact trades as soon as I answer them. Imagine being able to take that trip you've always been dreaming of, knowing that your money is still working for you. The link is in the description below. I'll see you in the community. NVIDIA, ticker symbol NVDA. Now, NVIDIA is the worldwide leader in GPUs, graphic processing units, and they are at the forefront of making chips that allow AI, artificial intelligence, to do exactly what it needs to do. So everybody loves NVIDIA. Everybody is looking to purchase their products in order to grow their businesses. And because of that, NVIDIA has gone up quite a bit over the last several years. And I love NVIDIA. I've made a ton of money off of NVIDIA, but I would like it at a cheaper price. So let me show you how I plan to trade NVIDIA this month. Now, if we come over here and we look at the analyst price targets for NVIDIA, we can see that analysts have it as a high target of $200, a mean target of $149.99, and a low target of $90. But currently at a 4.76, that means it's a strong buy. And this is obviously covered by a large amount of analysts at 41 analysts. So with their mean target being $149.99 and their current price being $134, NVIDIA could possibly still have a lot of room to run. But let's check what the expected move might be. If we stick with that same expiration date 15 days out, we can see they have it at an upper price of $142 and a lower price of $126. So I will be selling puts on NVIDIA, but if you're not familiar with selling puts, let me give you a quick recap. So selling puts has 2 different objectives. One is to generate income and or acquire the underlying stock at a lower price. And here's a quick example of that. So let's say Apple stock is currently trading for $175. And you want to buy shares of Apple, but you want it at a lower price. So you set your strike price to $165 and your expiration for 30 days out. And for doing so, you will receive $200 in premium. Well, as long as Apple stock stays above that $165 strike, you will make your $200 and you will go about your day, and then you can sell more puts at a later time. However, if the stock price drops below the $165, then you will be forced to buy Apple shares at that strike price. But that works out perfect for you because you wanted to buy the stock anyway. So really, it's a win-win. But let's go back into Thinkorswim and place our trade. All right, so I'm currently at NVIDIA's options chain. You can see ticker symbol up here, NVDA. And I selected the exact same expiration as we did with Tesla, 15 days out from now. Now, if you remember back, they said that NVIDIA's expected move on the lower end, 15 days out from now, would be 126. So I would be looking to select a strike under 126. And now with deltas for selling puts, I typically go anywhere between 0.10 and 0.20. So let's move over here, look at the delta. All right, so the $125 strike is at 0.20. So I will go even lower. For this, I'll do 122. That gives us a delta of 0.15, aka a 15% chance that the stock price drops to 115 by our expiration date. All right, so at 122, I will right click, hit sell. I'll go to single. And for this, I will receive $109 per contract that I sell. So now I just need to determine how many contracts I want to sell. And we'll say for this case, we'll do 5. All right, perfect. So I selected 5 contracts. I hit confirm and send, and we'll see that I will receive an immediate $542 for placing this trade right here, right now. But also keep in mind, if you're selling puts, you need to be able to purchase 100 shares of the company if the stock price falls. And I know you're probably like, Rashad, man, I don't have that much money to spend on NVIDIA. All right, perfect. Let me show you a way you can do the exact same trade in a much smaller account. Now, if you have a smaller account and want to trade NVIDIA, you could use a leveraged ETF. And a leveraged NVIDIA ETF that is perfect for trading in small accounts is ticker symbol NVDX. As you can see here, NVDX is currently $17. So let's go back to Thinkorswim, and now we'll put in NVDX into the options chain. And NVDX only has monthly expirations. However, if you want a leveraged ETF that follows NVIDIA that has weekly expirations, you can use NVDL. But that stock is currently around 50 something. So we'll use, if you have a small account, we'll use NVDX. So we'll come over here, we'll go to the expiration that is 36 days out, and same exact thing, come over to the delta column, and I want to select anywhere between the 0.10 and 0.20. So it looks like I'll be selecting a strike of either $12 or $13. So I'll select the 13, hit sell, hit single. And it looks like I'll be paid anywhere between $50 and $55 for this one contract. And since the stock is only $13, I would only need $1,300 on hand to run this trade. All right, and now the third stock that I will be trading this month is Upstart, ticker symbol UPST. Now, Upstart is an AI lending platform that partners with banks to provide affordable credit. You can essentially think of them as like a competitor to FICO. America has used the FICO credit score for several decades now, and FICO looks at certain factors in order to distinguish somebody's creditworthiness. However, Upstart has created their own platform using artificial intelligence to further determine a person's creditworthiness. And throughout the years, they have several studies showing that their model is much more effective than the FICO credit score at determining someone's creditworthiness. And so because this company deals with loans, they do much better in a low interest rate environment. And now that the Fed is starting to cut rates, Upstart has gone up since then, and I believe will continue to go up over the next several years. So if we look at their chart here, this is a 1-year chart, but you can see they were as low as around $20, and now ever since they started to lower interest rates, they have jumped up quite a bit and are currently trading at $42. Well, again, this is another company that I would love to own. However, it is a much smaller company than, say, an NVIDIA or a Tesla. So let me show you a way to trade this while also mitigating some of your risk. And so for Upstart, in order to create income as the stock moves up, but also wanting to mitigate my risk, I will use credit spreads. So the objective of a credit spread is to generate income and profit from the stock price staying above or below your strike price. Now for us, we'll be using bull put credit spreads, so we will want the stock price to stay above our strike price. All right, so bull put spreads, selling a put option with a strike price closer to the money and then buying a put option further from the money. All right, so in this case, we have a stock that is currently around $81. So what we can do is immediately sell to open a $73 put and then buy to open a $70 put. And for this, we'll receive $100 with our max loss being $300 because there is the $3 difference between our strikes. And in this case, for this trade, as long as the stock price stays above that $73 strike that we set, we'll just make money and go about our day. But if the stock were to tank, then our max loss would be just $300. So let's go place a real Upstart trade. All right, so I have Upstart pulled up right now, so we can see the price is currently $42. It's down about 1.88% today. But we selected the exact same expiration date as the other two, 15 days out from now. And I'll just come over to the delta, and I want our short strike price to be somewhere between 0.10 and 0.20. So I'll come over here. It looks like I will be selecting a strike of $37 or less. So I'll come over to the $37 strike, hit sell, and then I'll go to vertical. Vertical spread is another word for a credit spread, essentially. And let's say for this trade, I only want to risk about $400 per contract. So I'll select a strike for our long put that is $4 away from our short put. So we selected $37 for the short put, so I'll select $33 for the long put. All right, so my max loss for this trade would be $400. However, I can receive anywhere between $40 and $53 per contract for this trade. Well, that's it, folks. Those are the 3 stocks that I will be trading this month. If you like the info here, if you want to learn more from me, if you want to see my exact trades, feel free to join our Trade to Freedom community. The link is in the description below. We would love to have you. I would love being a small part of your future success. But either way, I'll see you guys in the next video. Peace.